Today, I want to continue my series on long-term care insurance, and the topic of discussion is going to be two different kinds of elimination period. One that is reckoned according to calendar days, and the other that is calculated in terms of what are called service days. The majority of long-term care insurance policies bought and sold today have elimination periods. Now, I have explained this term more fully in another video, but in general, an elimination period is a period of time where you have to wait to start receiving your long-term care benefits. Now, the period only begins once you are termed benefit eligible, and during the elimination period, no benefits will be paid to you. For this reason, it is sometimes referred to as a time deductible, and it's usually specified as a certain number of days. Now, in theory, the number of days could be anything from 0 all the way to 365, but in practice, most elimination periods are going to fall somewhere between 30 days and 180 days. Some carriers may have 0-day riders. They may also have elimination period waivers, but those are going to cost extra. Now, usually, the shorter the elimination period, the higher the premium cost. So the longer the elimination period you have, the lower the premium cost. And in this way, they function similarly to more familiar health insurance deductibles. Policies with high deductibles usually cost less in terms of premium, so it's a cost-saving measure. In terms of long-term care, the elimination period again represents an interval where you are on your own to pay for your care. Therefore, keeping track of how long this period lasts is of great importance to policy owners. And it turns out that there are two different ways of calculating just how long the elimination period lasts. The first of these is referred to as the calendar day method, and the second is referred to as the service day method. Briefly stated, policies that count calendar days consider every single day to count toward the satisfaction of your elimination period, whether you receive long-term care services on that day or not. The days following your certification as chronically ill are sometimes referred to as days of disability. On the other hand, when a policy only recognizes service days, if you did not receive long-term care on a particular day, then that day is not counted toward your elimination period. A couple of examples might be helpful. Suppose John has a long-term care insurance policy with a 90-day, one-time, lifetime elimination period, which is a typical amount. Let's take a look at what could occur if that elimination period is calculated in terms of non-consecutive days of service. Recall first that long-term care policies have to be triggered in order for a person to be benefit eligible. Now, tax-qualified long-term care policies usually have one of two predictable triggers. The first is that the person lacks at least 2 out of 6 activities of daily living, and the second is that they're cognitively impaired to such an extent that they require substantial supervision. And of course, both of those two things could be true at the same time. And I've covered these topics more fully in some of my other videos. A few long-term care insurance carriers may allow you to backdate the day of disability, but this is going to be very case and contract specific. So let's assume that for whatever reasons, John is certified chronically ill on January the 2nd. This means he is now benefit eligible and will start receiving paid benefits as soon as he served his elimination period. But how long will this take? Well, in our example, we said that his elimination period is 90 days. Now, to see how long this could take if his elimination period is reckoned in terms of service days, let's make a few assumptions. In his situation, let's say that he receives long-term care services 3 days a week. Suppose it's Mondays, Wednesdays, and Fridays. Now, we know in advance that if he's only receiving services 3 days a week, and his policy only counts days he's receiving services, then it's going to take him 30 weeks to satisfy a 90-day requirement. He'll have 90 days of service when he hits 210 calendar days, and that's about 7 months. Now, to visualize this, let's actually look at a sample calendar. John is benefit eligible on January the 2nd, and at the end of January, he has 12 days satisfied. By the end of the second full month, he's got 24 days. But on the service day calculation, John won't satisfy the full 90-day requirement until the end of July. So when does 90 days take 7 months? When you're only receiving long-term care services 3 days a week, and your elimination period is only satisfied by days of service. Now, as an aside, the number of hours of service required to count as a day of service would be specified in your contract and is liable to vary. To keep your out-of-pocket expenses as low as possible, you want to keep careful track of that minimum hour amount and hew closely to it. Now, let's compare this with Jane's policy. Let's say her elimination period is also 90 days, but this time she has a calendar day accounting method. Calendar day calculation methods are often, but not always or exclusively, conjoined with indemnity policies. This is because such contracts pay a daily benefit amount regardless of the cost of care or the services you receive. These indemnity plans are contrasted with reimbursement policies that calibrate payouts to the actual cost of care up to contractual limits. So in Jane's case, again, she is long-term care eligible on January the 2nd, and after that determination is made, you can simply mark off 90 days on the calendar, and that brings us to around April the 2nd. Therefore, Jane can expect her first benefit check after approximately 3 months. This is, of course, 4 months less than John could expect to wait on our first example. And notice that in Jane's case, it didn't matter if she received long-term care services on any particular day or not. Now, of course, we could change the example in a number of ways. For instance, if John receives long-term care 5 days a week instead of only 3, then he could hope to satisfy his elimination period in a little over 4 months. And conceivably, if he's getting services 7 days a week, then he will satisfy his elimination period in the same period of time that Jane would, even though the elimination calculation methods are different in both cases. If your claim begins when you're receiving care 24/7, for example in a nursing home, then the practical difference between a calendar day and a service day elimination period is often virtually non-existent. On the other hand, if he's only receiving services twice a week, then it would take him 45 weeks, or almost an entire year, to satisfy a 90-day elimination period. The moral of the story is, the more frequently regular care is needed, the more quickly a service day elimination period can be satisfied. There are a few additional things to consider. Firstly, what is it to have a qualifying service? Usually, qualifying services are those that you pay for from a professional long-term care service provider. A quick and dirty way of just getting a fix on whether a particular service would count as qualifying or not would be to ask the question, would that service be paid for by the contract once the elimination period is satisfied? If a particular service would be paid for, then it probably is going to count as a qualifying service. Secondly, it is important to underscore that care received from family members, friends, and so on is not generally going to count as a qualifying service. And this is likely to apply even if your family member is a trained long-term care professional. Often there are contractual exclusions against what is called informal care. Then probably if your elimination period is a service day elimination period, you're going to have to pay for non-family members to care for you in order to satisfy it. However, check your contract for your particular details. And when in doubt, consult with a trusted advisor. Now, thirdly, you should be aware that if you want your elimination period to be counted by calendar days instead of service days, that has to be arranged for in advance. Once a contract is signed, it is not likely to be amendable. Now, a few insurance carriers do offer calendar day options as part of their contracts, and it is to be expected that these calendar day contracts are going to cost more than their service day counterparts. Other providers offer calendar days as an option or what is termed a rider. But fourthly, make no mistake about it, whatever kind of elimination period you have, it is a period of time where you have to pay for your own care. Now, sometimes on the calendar day method, a person could arrange for family care in order to keep their long-term expenses down while they're waiting for their benefits to be payable. But as we said, on a service day model, this strategy is unlikely to work. Now, you can get a fix on what your out-of-pocket expenses might be by taking the number of days in your elimination period and multiplying it by your expected cost of care per day. So if you expect your cost of care maybe to be $100 per day, then a 90-day elimination period could cost you $9,000. If your cost of care goes up to $200 a day, then a 90-day elimination period would cost you around $18,000. And these are simply illustrations. If you had to enter a nursing home straight away after being certified chronically ill, your cost of care could be much higher. For example, just to keep the numbers simple, if a nursing home costs $100,000 a year, then even 3 months of care could run you $25,000 out of pocket. Fifthly, in my examples, I assumed once per life elimination periods. That means you only have to serve that kind of elimination period one time. You should be aware that some carriers have elimination periods that are calibrated to episodes of care and that may have to be satisfied more than once. And for an example of that, suppose you lack 2 out of 6 activities of daily living, but you enter into some kind of nursing care and you're rehabilitated. Well, after that, if you were to require further care down the road, assuming you haven't exhausted your benefits, on a policy that does not have a one-time lifetime elimination period, you may have to satisfy a second elimination period the second time around. For cognitive impairment situations like Alzheimer's and other forms of dementia, it may be highly unlikely that a person could ever be rehabilitated. The point, however, is to simply be cognizant of the type of elimination period that is associated with any policy that you're interested in or that you own. Sixth, and relatedly, I assumed that John's service day requirement could be satisfied by non-consecutive days of service. But you should bear in mind that other policies might require consecutive service days instead. Again, this just underscores the importance of understanding your contract's provisions and seeking professional advice wherever appropriate. Seventh, and finally, there are differences in terms of what care environments are covered by a given long-term care policy. For the purposes of my examples, I assumed what are sometimes referred to as comprehensive policies. Now, these policies cover you in a variety of care environments. So, for example, they might cover adult daycare applications, assisted living, they might cover home care, and nursing home care. They may also apply in specialty applications such as hospice care for end-of-life scenarios, as well as respite care to give caretakers a break. Other policies, on the other hand, are facility only and may be calibrated to certain care environments such as assisted living facilities or nursing homes. And a few policies might actually be home care only. Now, these differences can also affect elimination period satisfaction requirements. In the case of a non-comprehensive policy, for example, facility only, it is likely that you're going to have to serve your elimination period in a facility that qualifies. Even comprehensive policies can be somewhat complicated, as they may have one elimination period for home care situations and a separate elimination period for facilities. Consult your contract for details. The bottom line is that it is sometimes difficult to say whether a calendar day option is worth it after all. Some online sources will suggest that it is, some suggest that it isn't, but at the end of the day, it's your money and it's got to be your decision. It's definitely a conversation that you should have with your insurance agent or broker and with other trusted advisors who can give you a second opinion on any contract that you are contemplating. But let me say just a few things in summary. On the calendar day method, once you're benefit eligible, every single day counts towards satisfying your elimination period. And that's the case regardless of whether you've received long-term care services that day or not. On the service day accounting method, however, unless you've received long-term care on a particular day, that day does not count. So you might say that calendar days are easier to satisfy, but premiums for such a policy will cost you more. On the other hand, service days are harder to satisfy, which is why premiums on such policies will often cost you less. Now, as always, this video was for general informational or entertainment purposes only. Nothing I've said is to be construed as specific advice. There are many complications and many permutations of various contracts that I probably haven't even gotten into. But if you found something of interest or of help in the video, I ask that you like the video. If you'd like to see additional content, I invite you to subscribe to the channel. And if you click the notification bell, you'll be alerted to new content as it becomes available. Either way, I thank you so much for being with me today, and I look forward to seeing you again in another video. Thank you so much.